My name is Mike Loukas. I'm the CEO of True Shares ETFs, and we're here at CBOE today to chat about two CBOE listed products, the True Shares Quarterly Bear Hedge ETF and the True Shares Quarterly Bull Hedge ETF. Like we usually try to bring advisor insights into the discussion, we've also got a great guest with us today, Phon Vilayoune of Veta Investment Partners. Phon, one of the earliest adopters of buffered ETFs and the True Shares Structured Outcome ETFs as well, but not the only tool in your tool bag. I know that volatility management with your model business is extremely important and amongst the other product lines that you have. So I wanted to talk to you about QBUL and QBER.
Sure.
I know that you're a fan of both and an allocator to both.
Yeah.
And so my first question is, how do you use QBUL and QBER to smooth out portfolio returns?
Sure. I mean, that's what these ETFs are designed to do, smooth out, especially on the downside. So I think QBER is very unique, having been investing in ETFs for the last 20 years. We've had some positions in risk mitigation downside ETFs like QBER, but 2022 is a great example. Some of these positions have had too much interest rate exposure, so they actually didn't perform as well. And then some of these risk mitigation ETFs are actually too volatile, meaning that they'll go up a lot if there's a bear market, but usually there's not a bear market, so then they'll go down a lot if there's a bull market or flat market. That's why I'm so excited with QBER. It's kind of in the middle. It's going to be flat or generally down if the market's up, and then it's going to be up when the market's down. So that's why QBER is very unique. QBUL is also unique, is very similar in terms of smoothing out the upside. It's going to be flat when the market's down, but then it's going to be hopefully up when the market's up. So I'm actually really excited to have those out and be able to invest in those.
Well, I'm going to put you on a spot because it brings up another question. I'll call it a corollary to what you just answered. Because obviously, smoothing volatility is the goal. Mm-hmm. And the reason we have two products out there, Bull and Bear, the reason they're quarterly is because different allocations or different combinations can achieve different goals. Mm-hmm. And certainly you have multiple models that have different expectations. So what types of combinations, or is it a fluid environment for the bull and the bear combinations that allow you to tackle volatility and smooth out volatility for an investor's portfolio?
I think investors should consider almost having both in the portfolios. For example, if you're bullish on the market, let's say you want a 10% allocation to risk mitigation, you take 75% of that, put that in QBUL if you're bullish, but also like no one knows what's going to happen, so you put 25% in QBER. That's a possible allocation. And you can also construct 50-50 if you're kind of agnostic, but generally the market's going to go up or down. So that's the beauty of these structures. How we're going to implement them in the portfolios, we're always going to have both.
And then I ask this question about all products because I think it's part of the gap we bridge as ETF managers or portfolio managers like yourself with financial intermediaries and advisors. What bucket do they go in? What aspect, what segment of the portfolio are you putting these products in?
The beauty of these things are they protect against stock market volatility. So almost every client has exposure to equities. So I think it's applicable to every bucket. Again, it just more comes down to an allocation and tying it to the risk tolerances of your end client. For younger clients, probably have a lower allocation to QBER. For older clients, might have a higher allocation to QBER. And that's how we're going to implement it in terms of our client portfolios. I think I forgot to answer your quarterly question. The beauty of the quarterly structure within the ETF is it tracks the market closer. For example, if the stock market goes up 10% in the quarter, then all the options in there kind of track the market automatically in the ETF versus me or some investor having to go find another ticker. It's all rolled up in that one ticker solution. So that's why I think the beauty of the quarterly options within the single ticker.
So it takes the short-term tactical decision out of the equation.
Yep. But still, you still get the protection because, for example, if you buy like a 1-year option and the market drops 10% tomorrow, the 1-year option is not going to be as reactive to a quarterly option.
Yes.
So that's the beauty of what you guys designed. So.
Yeah, that's a great point. Yeah. Thank you, Phon.
Sure.
And I encourage everyone out there to go check out Veta Investment Partners if they want greater insight into how you structure portfolios and models, and certainly how you use volatility management products. So we thank you for your time.
You're welcome. Thanks.